So of course, today we're going to be talking about tax strategies that can help you keep more money in your pocket. Just so you guys know, we have two sets of audiences here tonight. We have the audience that is more W-2 wage earners, right? And then we also have a group of entrepreneurs. So we want to make sure that we give you guys all tactics that you can use that's going to help you save some money when it comes to your taxes, or things that you should employ to make sure that when you get into next year's taxes, if you can't impact this year, you'll be able to be prepared to do that, okay? Also, just taking a look at the calendar, these are upcoming webinars that we're going to have for the future. The goal is that, of course, we're doing Wealth Wednesdays, the first Wednesday of every month. You will notice in April, that one is not going to be the first Wednesday because we'll be on spring break, probably like the rest of you, right? So we will be kicking that one off that second week when we return, but we will continue on our series. The other thing you may have noticed on this is that we have left the fourth quarter vacant. So October, November, December, we do not have topics because we want to be able to use that as an opportunity as we hear from you all, to hear what you want to learn about, right? To hear what you want to know. So please feel free to shoot us an email, of course, connect at age18realty.com, personally to Alan or myself, or you can respond to the emails that you get from your registration. And that way you'll get us some information and we'll make sure that we can cover some topics that you want to hear about. Okay.
Yep.
So real fast. We have a couple of housekeeping items that we want to talk about. I think I skipped one. First thing is, Alan and Crystal Johnson, we're not tax professionals. So that is my disclaimer for this evening. I do not have any registration with the federal government saying that I can give tax advice. So with that being said, we are providing information and resources for you. Now, we do have a tax professional on here for you, and I will let Ronnie take the opportunity to introduce himself when we get to that point in the presentation. But however, you need to make sure as you take this information in that you're reviewing this strategy with your tax professional, okay? That's the person who's gonna be able to really know what's going on with your finances. They have a better view into the depths of what's going on in your life, so that way they can give you the best advice. We're gonna give you some great tips that you can take and carry forward to them, but you gotta talk to them, okay? Of course, all questions are welcome. However, we're going to do all questions in the Q&A. So we're expected to have over 100 people join this call this evening. So we want to make sure that we keep your time the way that we want to, and keep honest with keeping you guys at 30 minutes. So with that being said, put all your questions in the Q&A. We'll try our best to make sure we answer all those questions by the time we get to the end of the session. And then last but not least, please take action with the information that you get tonight. So often we can all go to conferences and listen to seminars, and we're on Instagram, listen to the best of this and that, and we don't do anything with the information. This information we're trying to put out there so that we can help us all move forward as a community, right? Move us all forward into building wealth for our families and taking advantage of the opportunities that are out there that have been positioned for us. The tax code is written in such a way so that you actually can use the things that are in place. So we want to make sure you are doing that, but make sure that you're taking action with the information. Okay. All right. One more thing, we are hiring. So if you know anyone who's looking for a fast-paced career in real estate, please send them to careers@age18realty.com. We are looking for specifically agents, so licensed agents who want to work in DC, Maryland, or Virginia. So if you know anyone who wants to learn a lot, grow a lot, engage with a great team, we're it.
Yes.
So just let them know about it.
Yeah.
All right. And then of course we love referrals.
Yeah,
so we want to make sure you guys know that we want to pour into you, want to give you a lot of value. But the way that you can truly help us and help our business and impact our business is thinking about us when your friends, family, loved ones, people who are relocating from different parts of the country need a real estate professional like us, send them our way.
Yep. So guys, so real quick in the Q&A, I want you to write a question, right? Something that you want to get out of this. So just go into the Q&A. If you have a question, I want you guys to get active, and there's going to be a reason why I want you to get active. So go into the Q&A. What is your question? Are you W-2, 1099? Just put anything in there so we know what you do. So I want to talk to you about the art of referral, and it goes a little bit something like this. So this is who we are. You guys know that we service, that we sell real estate. That is what we do. We help people buy and sell real estate, right? Who are we? Our numbers kind of speak for themselves. We're probably the largest agent that because we've been doing it for a long time. We sell a home every 36 hours. We've done a high volume of real estate. There has not been a market that we haven't been in at a high level. So that really plays into the advantage of our clients, right? You could pick your aunt, you could pick your best friend, but if they haven't been through the storm, I'm not sure if you want them to navigate you through a real estate transaction that can really make or break you, right? Where do we serve? We serve DC, Maryland, and Virginia, 2 up, 2 down. And we're connected worldwide. There are a lot of agents that are on this call right now that are part of our nationwide network. So here's the beautiful thing about working with us. If you have someone that's moving to another area or you're moving to another area, we have a nationwide network of agents that we've already vetted, that are awesome, that are professional, that are like us, that we can refer to you, right? Here's the beautiful thing. Agents don't tell you that that actually benefits us. We get paid to refer you other agents, right? And I know you guys like to help us, right? So there's a great way for you to help us, even if you're not buying a home, is to refer someone in a different area who's going to get the same level of agentry. That's like 4 words I made.
Oh, goodness.
You get it.
We're gonna give them a dictionary.
Yeah, you get it, yo. But you get the same level, so it's a win-win. All right. What will you refer? Your only job is to connect us, guys, and we'll take it from there. So if you just put it in an email or a text message, hey, this is Alan, this is Crystal, this is the AJ team. They're awesome. You should connect. That's all we need you to do, right? We don't need you to sell us. We just need you to connect us, right? And how will you refer? This is pretty simple, a text message. And that's funny, man. Last Wealth Wednesday, we had like 7 people that did this, right?
We appreciate it.
They just were really intentional about doing this. So you just put us in a text message. And here's the beautiful thing, like 2 of the people are buyers, 2 people are future buyers, and 3 people couldn't buy. But it's cool. Like that's what we're supposed to do, is to go through those conversations with people. So Alan meet John, John meet Alan. Just thought you 2 should definitely connect, and just put it into a text message or email and let us take it from there. And this is the story I want to tell you. So Ronnie, I don't even think you heard this story before. Do you know how I got introduced to you?
No, I don't know. No.
Yeah. So all you guys know, I went to George Mason University. We ended up selling a property for a young lady. She might be on this call, named Tammy Anderson, right? So Tammy Anderson is awesome. She's referred us a couple of clients. She used us for a buy and a sell. And she just one day, she was really intentional. She's like, Alan, like, I just got this guy that you should meet. Like, I just think that your synergies are really, really good. I know what you're talking about. I know what he's talking about. You guys should meet. So we set up a conversation with Ronnie. And Ronnie was the first person he wasn't the first person, but I'm starting to understand the value of a person's hour. And he was like, hey, we can have this quick consultation, but my full consultation, regardless of whether you use me or not, is this amount of money. And I knew instantly that he was going to be worth well more than that, right? And it was like, she was so intentional about referring Ronnie. Ronnie's now our full-time tax guy, so we connect on many levels. But if Tammy wasn't intentional about connecting us, then you guys wouldn't be getting the benefit of this free information, right? So when you think about intentionality, you're connecting us because you just don't know how that seed of blessing is going to blossom somewhere else, right? So you connecting us with someone who's buying and selling is a blessing. It's the same effect that this is going to have on your life to our business. So if you get that good energy every time I go to the AJ team, I feel like I'm getting something good. I love the way they do their business. Be intentional about going out of your way like Tammy did to connect us. All right. Don't passively make referrals. Be sure to the connection is made. And if you give us 2 referrals a year, each of you, it changes our business. Okay. You can send referrals. I'll let you go through this.
Yep, you can send them to referajt.com. So we have a website for that. You just submit the information there. You can always email us at connect@ajteamrealty.com for anything. If you just have questions, you can do that. And you can text us. So housekeeping is done. Let's get to the meat and potatoes of why you are really here this evening. Actually, we do have one more thing.
What's up?
Hey, we have one more.
Yeah. Our Raven fan of the month. So every month we're going to do a Raven fan. Edwin and Brandy Garrett have referred more than 10 referrals to the AJ team. So we are going to honor you as the Raven fan of the month, and we are going to send you to, I know you guys like shows. So we thought about the Wolf Trap. So we're going to give you a $200 voucher so you can go to the Wolf Trap this summer and see a great show. I heard John Legend's going to be there. all that good stuff. So
Yeah, we appreciate you guys. Awesome. Now, back to the meat.
let's get it.
All right, let's get this going. All right, Ronnie, you want to take a moment to introduce yourself, and I will give you control of the screen, sir.
All right, let me get control. I'll introduce myself and we can get started. Let me just say this, Tammy, if you're on here, I forgot, please do not kill me for not remembering that. Let me just clear myself of that. All right, thank you for giving me control. All right, I'm going to share my screen with everybody. And Alan and Crystal, let me know if any logistical things are kind of messed up, but I think we should be good to go.
Okay.
Good to go.
All right.
Cool.
Share. All right. Do my slideshow. All right. Thumbs up.
Yeah.
We're good.
All right, we're good. All right. So let me first introduce myself. As Alan and Crystal knows, I love to talk about taxes. I love taxes. Taxes are the world to me because I got a different understanding about it. But my name to folks out there, I am Ronnie Good. I am a CPA, certified public accountant. I'm licensed in the state of Virginia, but I serve clients all over the United States. Well, actually the world, due to the use of this technology thing that we're on right now. So what we do in my company called Rhythm Accounting, we work with taxpayers and we help them leverage the tax code in order to build wealth. Notice I didn't say that we just do taxes, although that's a very important step, a very important piece. We take it beyond that and help folks maximize the tax code by being more proactive, because taxes can either eat at your wealth or it can help you expedite your wealth, okay? So that's a little bit about me. But now let me turn this camera off and let's get right into this discussion because I want to keep us to our 30-minute promise that we have. All right, so before I can get you into talking about the 3 tax strategies that you should know about to keep your hard-earned money in your pocket, the first thing I need to do is to kind of level set and bring you to my perspective, all right? So they say that the tax code is over 70,000 pages long, and if you print it out, and a small portion of the tax code tells you how to pay taxes, but there's a large portion of the tax code that tells you how to save money on taxes. It's just reserved for specific groups of people, and it's not the wealthy. Let me just, that's spoiler alert. All right, so the question then becomes, who does the tax code mostly benefit? All right, who does the tax code mostly benefit? So if you look at the tax code, and my screen is not moving, give me a second. All right, let me do it this way. So who does the tax code mostly benefit? So if you look at the tax code, it's 2 particular groups of people that benefit from the tax code the most. And that is business owners, entrepreneurs, even folks that have a side hustle, or investors. Okay, and I'm talking about people that invest in securities or people that invest in real estate. And the reason why the tax code benefit these individuals is because they do what the government asks them to do. It's really that simple. Just think about it from a business owner perspective. The reason why business owners get a lot of write-offs and incentives within the tax code is because ultimately, when you get into business, you're going to grow your business, and then it's going to result in you creating jobs. So the government wants more jobs. So what they do is incentivize business owners to get into business to create jobs. Fair enough. Let's look at investors or real estate investors, okay? So from a real estate perspective, what do real estate investors create ultimately? They create housing. So the government wants more housing. So what they do is incentivize people through utilizing the tax code so that they can take write-offs and create more housing. So the best thing to do if you want to take advantage of the tax code is to do the things that the government wants you to do. Okay, so it's not about the wealthy, it's about the informed versus the uninformed. All right, because all the wealthy people are doing all of these things that the government wants them to do. All right, so I had to kind of bring you to my perspective and level set us. Now let's get into the first tax strategy. So we're going to start light and then we'll turn it up a little bit. All right, so the first tax strategy is the home office deduction. So typically when you hear people say that, you know, they bought a home and they start to tout all the benefits of having a home from a financial perspective, they talk about how, you know, homes go up in value over time. They also start to talk about, yeah, and also I can write it off on my taxes. Typically what they are referring to is taking a tax deduction for the interest that they pay on their mortgage and also property taxes. But outside of that, you're pretty much limited to the things that you can do, because there was a time where you can take miscellaneous deductions, but the Tax Cuts and Jobs Act got rid of that. So now, in order to maximize the deduction of having a home, you can take advantage of the home office deduction. And here's how you do that. So all you have to do is have a home and have a space within your home that's used regularly and exclusively for business. All that means is that you can't have your bedroom that also has a desk or a monitor over there and try to call that your home office. That's a dual use space. You have to have a space that's used regularly and exclusively for business. And once you have that space, the good news is that you'll be able to take deductions for all the indirect expenses of the home. Yes, you get the mortgage interest and the property tax, just as you would without taking a home office deduction. But in addition to that, you get insurance, you get to write off utilities, water, sewage, electricity, right? You get to write off repairs, you get internet and Wi-Fi, things that are indirectly related to you owning and operating basically that home. And anything that's directly associated with your home office, you get to write that off in full. You don't have to take a percentage based on the business use. Okay, that's the home office deduction. Let's look at two different ways in which we can take the home office deduction. So the first method, they call it the simplified method, but I call it the lazy method. The reason why I call it the lazy method is because you get $5 per square foot for up to 300 square feet. That's a $1,500 deduction. For most folks that I work with, that's not going to move the needle. All right. So if you're going to take advantage of a home office deduction, it's best that you get into utilizing the regular method. And that method simply states that all you have to do is come up with your business percentage, and that's based on the square footage of your business office compared to the overall square footage of the home. And then you can use that percentage to take deductions, okay, based on the expenses of your home. All right, let's look at a quick example as it relates to this home office deduction. So hopefully this isn't too overwhelming. So let's say you purchased a home for $450,000. You had a down payment of about $45,000. That's about 10%. And you financed the rest with a mortgage, right? At 6.709% for the rest. So your home office percentage, based on you doing a calculation of the square footage versus the square footage of the overall home, is 25%. So you have all of these expenses that are associated with the home on the left side under the home categories, right? That's about $55,000 worth of expenses. Now, to the right of that, you will see we have a comparison where there's no home office versus there being a home office deduction. As you can see on the left side of the comparison, you get the mortgage interest and the property taxes. So that's about a $30,000 deduction. And if you're in a 24% tax bracket, that's about $7,000 of a tax impact to you, okay? Versus if you take a home office deduction, in addition to the mortgage interest and the property taxes, you get to deduct a whole bunch of other things, right? Which ultimately conclude in you getting a $44,000 deduction. That's about a $14,000 difference from a tax impact perspective. If you're in the 24% tax bracket, that's about a $10,000 tax deduction, okay? That's just a comparison of the two. A couple things to know about home office. So if you don't do the home office deduction, you must itemize in order to take advantage of the mortgage interest and the property taxes, okay? And today, in 2023, it's a little more difficult to take an itemized deduction. Prior to the Tax Cuts and Jobs Act, it was a little easier to do that because the standard deduction wasn't quadrupled. Now the standard deduction, if you look at married filing jointly, you'll see it's up to $27,000. So if all of your itemized deductions do not exceed $27,000, then you will not get the benefit of taking the itemized deduction. Just keep that in mind, all right? So that's the first tax strategy that you should know about to keep more of your hard-earned money in your pocket.
So Ronnie, I'm just looking at this here real quick. So a person who owns a home, right?
Yep.
And they're a W-2 employee, the
Yep.
first thing they should do is start a small business, even if they aren't really making a lot of money on the small business. They get this deduction. Is literally like you owning a small business by getting an LLC and actively working in a business, right?
That's correct. So I always say this, and I started off by saying the tax code mostly benefit business owners and entrepreneurs. There's a third one kind of under that umbrella, side hustlers.
Mm.
So all you have to do is to be into business part-time, and you can still get all the benefits that everybody else that's in business full-time get by utilizing the tax code. There's a guy I know, he sells candles on the side. He gets to take home office deduction and gets the benefit of owning a home as well.
He probably makes more in the deduction than he does in the candle business.
He absolutely, he makes more in the deduction than he does in the candle business because he does that on the side. And let me just add this one extra thing. So as you can see, some folks may not see this as a huge difference, right? In terms of no home office versus home office, but just think about it. Over time, your mortgage interest amount will decrease as you start to pay on that mortgage. It's going to decrease. So that means that if you don't have a home office, the benefit of you receiving that will decrease as well. Versus if you have a home office, you'll get way more benefit over time. So I just want to throw that out there. I think you're on mute, Alan.
Real quick, everybody, we're going to go over 30 minutes. Are you guys comfortable with this? Because we're going to keep flowing. This joint is probably too good for us to stop. We'll probably do like 6:40, so just make sure you're cool with that. All right, Ronnie, let's roll.
All right, so let's roll. Let's get into this next tax strategy. This is number 2. So we're going to turn it up just a notch. And this next tax strategy is probably in my top 5 of tax strategies. So I kind of love this one. All right. And go ahead. You got to take.
You said top 5?
Yeah, it's probably in my top 5. Yeah, I got a whole bag of tricks, This is in my top 5. I got some other things as well.
I want to see top 5.
I got you. All right, so let's get into this next tax strategy. All right. So the next tax strategy, like I said, is in my top 5, one of my favorites, and that is rental real estate. Rental real estate. You'll see why I love rental real estate. Let's talk about it. So anyone that has a property that they are using as a investment property, meaning you're a landlord, or you have a vacation home that you're renting out partially through VRBO or Airbnb, you'll be able to deduct the cost that's associated with that property, right? So that's things like for repairs, cleaning, painting, landscaping, insurance. Of course, you get mortgage interest and property tax, travel, right? Let's say I know some folks that invest in properties that are out of the state. So they travel to that property. So by them traveling to that property, they're able to deduct the cost of their airfare. They're able to deduct the cost of lodging at the hotels and 50% of their meals because they're going to visit their property. So travel is a big one. And the most important one, in my opinion, and a lot of folks that are in the real estate game will tell you, is depreciation. So as it relates to tax strategies and planning and things of that nature, depreciation is king. Do not forget that. I want to emphasize that depreciation is king. But let's talk about what depreciation is. Okay. So simply put, depreciation is basically a tax deduction that the government gives you that accounts for the normal wear and tear of an asset, right? So think about it like this. If you buy a piece of equipment, that piece of equipment is going to last you for longer than a year, right? There's a certain lifespan that's associated with that equipment. And actually, the tax code actually gives us schedules that tells us the lifespan. They call that useful life. So as it relates to depreciation, what we do is we get deductions for each year for that lifespan of that asset. It is really powerful. And one of the most important things about depreciation is that outside of the initial acquisition of the asset, you don't have to spend any additional cash in order to get a deduction. Let me explain that. So normally when people have a business, they have an LLC, S Corp, C Corp partnership, and they get to the end of the year, you'll start to see a lot of people look at their projections and their CPA and say, hey, look like you're going to pay this much in taxes. So a lot of people, they're like, oh, no, I don't want to pay that much in taxes. I don't want to give this money to the government. So what they'll start doing is spending money in order to get a tax deduction, even when they don't need the things that they're spending money on. In the tax world, we call that the tail wagging the dog. And you never want to do that, right? So the problem is that cash is leaving. Yes, they're getting a deduction, but cash is leaving the bank. Versus when you compare it to depreciation, no cash is leaving, but you still are getting a deduction. It's very powerful, okay? So the larger the asset, the larger the deduction. This is why a lot of real estate investors benefit from having rental properties, right? Because it's a building residential property or commercial property. These have a huge value to them, so they get larger deductions. And I'll give you one last one really quickly. If you start to look at celebrities, a lot of celebrities are now buying jets, right? Yes, they can justify it for the moving around and being able to get to cities within an efficient time, but they get a huge depreciation deduction for it. Okay, so hopefully I hammered down on depreciation. Let's look at a rental property example. This is a real example from one of my clients. So one of his properties, he had a purchase price of $550,000, of which $55,000 was allocated to the land. And he had this property for a while. He's almost done paying the mortgage off. So last year, he had rental income of $17,400. And then he had all of these expenses that were associated with it. So if you do quick math and kind of calculate, okay, I got rental income and I subtract all of these things with the exception of depreciation, this would have left him with a profit of close to $2,000. And all he would have to do is add that $2,000 to his other income from his job that he worked as a W-2 or from his business, right? And then he would have paid taxes on that. But because of depreciation, he gets this $18,000 deduction that drives his rental property into a loss. And now he's able to use these losses from his rental property to offset his income from his W-2 job and his business. This is the power of rental property and depreciation. Hopefully y'all are hearing me on this one because I'm trying to emphasize it. Anything on this, Alan, Crystal?
Yeah, that's essentially like he made up almost $1,500 a month.
Yep, if you do the quick math on it, yep.
Yeah, so guys, people buy real estate for a couple of reasons. Everyone's always focused on the cash flow, right? How much cash flow can I get? High net worth individuals don't necessarily need cash flow because the more cash flow they get, the more taxes they'll pay. So you guys that are making money, you shouldn't really, honestly, there are a couple of things that you should be thinking about. You should be thinking about appreciation. If I buy this property now, in 20 years, what would this real estate be worth? Cash flow is actually last, right? As long as you're breaking even, the secret sauce, guys, is in the depreciation. Like you get that regardless of rental rates, right? So when you're looking at investing in real estate, and to our agents out there, I think it's really important you guys get a handle on this because this is what we don't tell people, right? We tell them about everyone. A lot of people won't buy investment real estate because it doesn't cash flow as well as they want it to be. But there are two other components to owning real estate that are vital. And now that I look back on it, especially with our apartment buildings in Arlington, we own 12 Airbnbs. The secret sauce is in the tax benefits, right? So just kind of think about it, that if you know some high net worth individuals that you need to connect us with or connect Ronnie with, make sure you connect us. This is really good so far, man. What, you can't top this, dog. What else you got?
I got something else. Let me add a little commentary to what you just said, because that was very powerful. So to a lot of high income individuals, if you work in a W-2 job, right? Let's say if you're a doctor, you're an attorney, you're an engineer, or you work in the tech space, you normally have a high W-2 income. And I hate to break it to you, W-2 income is probably taxed the heaviest, right? That's earned income, right? So what I like to suggest to a lot of those high income salary folks is, especially if they don't want to start a business, I said, okay, you don't want to have another job that you got to, it takes a lot to start a business. I say, what about diversifying your investments into getting into real estate for all the benefits that Alan mentioned, plus the tax benefits, right? Because it can help offset some of that income that you're getting from your W-2 job. So I just kind of want to put that out there. All right. All right. Let's finish up with the third strategy. So the third strategy was kind of inspired a little bit by my real estate agents, the folks that are in real estate sales, and you're going around, you're kind of showing homes and things of that nature, right? And you have clients that you're selling to. At some moments, sales can be up. Some moments, sales can be down. That's the sales business, right? It's kind of bittersweet. When sales are high, you know, it's a good thing because you had a good month, but you also have to think about taxes. So the thing that I came up with for my real estate agent is the, my thunder. Okay, here we go. Auto deduction. All right, so let's get into this auto deduction. And this is a very popular thing all over social media, but it's very nuanced, actually. Yeah, I don't know if your accountants are really telling you about this, but they talk about the concepts a lot online. But let's talk about the auto deduction. So obviously, here are the basics. So if you're going to use your vehicle, obviously you use your car for business in order to take advantage of the auto, right? And another thing you want to do is to track your mileage. So you can do it the old school way by having a hard copy mileage log that you use, or you can use an application like we do in 2023 with all this technology. So they have Mile IQ, QuickBooks have a version that uses GPS technology. So anytime you leave and come back, it actually, whether this travel was for personal or business, you swipe left or right. Pretty fair enough, right? One thing to know about auto and car deductions and writing off a vehicle is that commuting is not business miles. So think about that. If you're driving from your home to your office, that is considered commuting. The IRS doesn't give you a deduction for that. But as soon as you leave your office and you go out into the world, you go meet with a client, showing them a home, right? All across town. Or if you go to the store for supplies, right? That's when you can start tracking these business miles so that you can get a deduction for it. Okay. One thing I do want to add, especially with the auto thing, because I've seen this early on when I first started out about 15 years ago. People think that just because you slap a sign on your vehicle that you can take advantage of the car deduction. It's not based on a sign. It's actually based on two things. On the next slide, I'll explain it. So there are two different methods to get a deduction on your taxes as it relates to the auto. So there's the standard method, which in 2023, you get 65.5 cents per mile times however many business miles. And then there's the actual method where you'll have to determine your business use of your vehicle if you use it for both business and personal. Now, the actual method allows you to write off actual expenses like your fuel, oil and gas, any tires that you have to get changed, registration fees, repairs, tune-ups, as well as depreciation, because a vehicle is an asset as well from a tax perspective, but you also get to write off your lease payments. So let's say if you're leasing the vehicle, you get to take those write-offs for that, but you don't get depreciation along with lease payments. What I will say about this though, is this is just scratching the surface. The laws around writing off a vehicle are very complex and nuanced. They don't tell you about this online. They just kind of put it out there for marketing's sake. But a couple things that you should think about in addition to that is consider how long you're going to keep the vehicle, consider how many miles you're expected to put on the vehicle, and consider the cost of the vehicle. Those three things will help guide you to which method that you want to take advantage of, all right? So just sit down with your CPA tax professional and have a discussion about that. All right, let's look at a quick little example of writing off a vehicle because it can be very powerful. All right, so let's say that there's a client, right? They have a business and they want to buy a Chevrolet Tahoe. They run about $54,000 and they saying they're going to use this 100% for business. I will warn you, if you're going to write off a car and say it's 100% for business, just make sure you have other vehicles that are for personal use, because it's going to be difficult to, tell the IRS that, no, this is just my business vehicle if you don't have another vehicle. All right. So the benefit of being able to write off a vehicle, right, within your business is you can only put down, let's say $10,000. So $10,000 of cash will leave your business bank account, but you'll still get the full $54,000 deduction on your taxes. This is why this is very, very powerful, okay? Because you only spend $10,000, but you get a $54,000 deduction. So depending on which tax bracket that you're in, this can be a large tax deduction, especially if you need a vehicle for your business, all right? But I do have warnings about this thing because people do get excited over car write-offs and auto deductions. I'll tell you this, if you want to determine what you can write off in your business, look at it from three different perspectives. There are three things. The first thing is determine whether it's ordinary for your business, meaning it's common amongst other companies within your same industry. It's ordinary. The second thing is it's necessary, meaning this vehicle is essential for me to do what I have to do within my business. For example, I run a virtual accounting firm. It's necessary and essential for me to have laptops, monitors, webcams, and things like that, so I can justify the write-off. And the third thing to look at is make sure it is not lavish or extravagant. All that means is that it must make economical sense for your business to take such a write-off. For example, if I had a company that had $40,000 in sales, I should not be trying to write off a $54,000 vehicle. All right. I have to put that disclaimer and that warning out there. All right. So that's the last tax strategy I want to tell you guys about. Alan, Crystal, you got anything for that one?
Does that apply to anyone? We got people that are other, that are business owners that aren't real estate agents, but does this tax deduction kind of, relate to everyone?
This tax deduction relates to anyone that has a business. If you're self-employed, you're an independent contractor, what have you, you have a business. It just was inspired by real estate agents.
It should be inspired by real estate agents.
We're inspiring.
It should be.
Hey, Ronnie, that was great. So we do have some questions in the chat. So I want to make sure that we get those questions answered. And those of you who have questions, while we still have time, go ahead and throw them in there and we'll try to get all of your questions answered. I know that Ronnie unpacked some great information for you. We're trying to keep ourselves honest to that 30 minutes. We're a little over it, but we want to give you the information that you need. I know that some people ask like, hey, can your next sessions in October, November, and December get Ronnie back in here to ask more questions? And we will certainly look into that. But the first question, Ronnie, that I have here is from Stephanie, and she wanted to know the top 2 benefits of being an S Corp.
Hold up, not just Stephanie. That's Stephanie on our team.
Stephanie.
And she's Spanish speaking. So if you know any clients that are Spanish speaking, Stephanie's awesome. And she's worked in multiple layers of our business. Yeah. And she's our newest AJ Team rock star. So not just any Stephanie. This is Stephanie.
Put some respect on Stephanie's name. Okay.
Right.
So the top 2 benefits, I'll get the first benefit out the way. So from a tax perspective, one of the main benefits of electing to be taxed as an S corporation is that you get to save money on self-employment tax. Okay. So if you look at yourself as just a sole proprietor and you have a business, all the income that you receive will be taxed at federal income tax, state income tax, and self-employment tax, which is 15.3%. Okay. Now, the benefit of electing to be taxed as an S corporation is that you receive income from the business in 2 ways. You receive a salary and you receive distributions. The major benefit with that is that 15.3% is only due on the salary, but not the distributions. Okay, that's why people elect to be taxed as an S corporation. So let me put that big one out there. 2 benefits. I'll give you another benefit with an S corporation. Let's say if you're the sole owner of an S corporation, you get to take advantage of what's called a solo 401k. I really like a solo 401k. Solo 401k allows you to save for retirement. You can't have employees, but you can contribute way more than you can to your work 401k, which is now $22,500. With the solo 401k, it's went up. Last year was up to $61,000 that you can contribute to that account and invest it in the stock market. And there's a Roth version that you can have to a solo 401k. So it can be completely tax-free when you take it out in retirement. So those are 2 things with an S corporation, but there are tons.
That's awesome. Thanks, Ronnie. Next question that we have. Oh, this is a great one, Ronnie. This is directly for you. Jay want to know if you work with businesses that are franchises. And if you do, he's ready to set up a meeting.
That's a good question. Yes, I do work with businesses that are franchises. And the way you can contact me, I'll get into the contact after we do the questions, after we do the Q&A. I got a slide that you have all my contact information, so we can do that. But I do work with folks that have franchises. Great question.
And Jay is also one of our partner real estate agents. He's awesome. So we will certainly be able to refer to Jay as well. Valerie is also another one of our partner real estate agents who joined us today. And she wants to know that if both her husband and herself are filing jointly, can they both claim the home deduction if they're running 2 separate businesses?
Not out of the same home. Okay, so you're going to have to combine it because you're filing jointly. At the end of the day, that means all of your activity pertains to you and your husband. It's all going to fall on one tax return. Okay, so the impact may still be the same once you do the calculation, though. Think about it, right? So if you're looking at the square footage, right, the square footage of your husband's home office and your home office compared to the total square footage of the home, that percentage should give you the same expense impact of a deduction. All right. So yeah, don't overcomplicate it. You should still get the same impact.
Yeah,
Yeah.
and unless you're working at the same desk, which we don't work at the same desk.
Nope.
Right.
The
That
other thing is that, so while we have our age 18 business, and it's good for you, Valerie, that we also have other businesses, right? So we do get to double dip on, I say double dip as if it's a bad thing. It's not a bad thing. We are permitted to do that, and we can do that on both businesses.
Mhm.
All right, next up.
Next up, we got Trevor. Hey, Trevor.
What
He
up,
wants to
Trev?
know that is depreciation always standard at 27 and a half years of the value of the home, or can that term vary?
That's a great question. So depreciation, we can go deep in depreciation, but I'll answer your question. So residential rental property, he's talking about property, okay? Because all assets have depreciation, all right? But he's talking about property. So residential rental property is depreciated over 27 and a half years, and commercial property is depreciated over 39 years, okay? So that's standard. It doesn't have to be standard, which is a lot of folks that's in real estate, they do things to accelerate that depreciation, meaning to shrink the amount of time that you depreciate it, which result in you getting larger deductions, okay? And that's a whole topic. We can do a discussion on that. But yeah, I just want to answer you that way.
In fact, we will. That's what we will do.
We'll add that to the
later in the
topics.
year, we'll talk about cost seg, because you really helped us with that. And for people who own real estate, that is big. And I'll tell you what we'll do. We will have Ronnie, and I don't know if you agree to this. Maybe you can come on later in the year, but only if we end up getting like 100 referrals, because that helps you too, right? You know,
It
so
helps me.
we can end up getting 100 referrals, that we can have him come on and give you game about cost seg. And if anyone owns a piece of real estate, you need game on cost seg. Like, it is the game.
We got cost seg, we got bonus depreciation, we got section 179, we got de minimis safe harbor, we got all kinds of stuff.
Hold up.
Thanks, guys. That's awesome. All right, Stacia, who's also one of our amazing clients and
Yeah.
friends. So thanks for asking this question. She had a clarification question for you, which is she thought that you had to be a real estate professional in order to leverage depreciation to offset W-2 income. Is that not the case?
No, you don't have to be a real estate professional. You can, and it's good to be a real estate professional because you get the major benefit. If you're not a real estate professional, so here's how it works. This is passive activity rules, right? So typically, passive losses can only be used to offset against passive income under the passive activity rules, code section 469. Okay, but there are two exceptions, right? Generally two exceptions. And we're talking about long-term rentals. All right, the first exception is called active participation. All you have to do is be actively involved in your rental property, and you make under a certain adjusted gross income amount, you'll be able to deduct up to $25,000 of losses against other income, W-2 income, business income. That's the first exception. The second exception for long-term rentals is the real estate professional status, okay? So those are the two exceptions when we talk about long-term rental properties. It's a whole different thing for short-term rentals.
Awesome. All right, Aaron. So just so you guys know, we got to give you guys backstories on all of our folks that are on this call today. Aaron, actually, his band performed at our wedding 15 years ago, which was amazing.
Wow.
So he's an incredible musician. So thank you for asking this question. His question is, should we place a rental property in an LLC or separate LLCs? Pros versus cons.
So the thing about LLCs, and I'll tell you this about all entities, any entity that you set up has both tax and legal implications. All right, just remember that, tax and legal implications. So from a tax perspective, whether you put it in an LLC or not, you'll still get the same tax benefits. Now, from a legal perspective, that's when you get benefits from putting it in an LLC. So what I like to advise people on, if they don't have like legal counsel that's counseling on certain things, I tell them that if they don't want to get sued, because an LLC protects you from being personally liable for the debts of the business or the property. If you don't want to get sued, you want to put your property in an LLC. That's what I'll tell you from a risk management perspective. But then I'll stop there and I'll say, if you need more legal advice outside of that, because that's not really advice, but go talk to an attorney.
Yes. Okay. Next question that we have here is, what about a bakery business? Is that considered a shared space? So if you're running a bakery business out of your home and it's a business, it's legit, is that a shared space?
So What else are you doing in that space? Always look at what purpose of that space. What's the purpose of that space? So I used to have my home office in my den, right? That's a place where I had people come over and things like that. I entertain guests, but I had my office there too, right? I couldn't take advantage of a home office because it's a shared space. It's dual purpose. So I would say the person that has a bakery, if you have a bakery, but you also use that to cook your regular meals, personally for your kids and family, you will be biting yourself, in the foot by actually trying to use that space, because you wouldn't be able to take advantage of the home office, right? So it's kind of tough, with that business. And my cousin, she cooks as well. She has a cooking business. I told her the same thing. I said, as soon as you can get into a separate space, that's when we can kind of utilize some of that stuff. Because if it's dual purpose, you won't be able to take advantage of it.
Yeah. And one thing I'll add to that is I know he has some neighbors, and you know what they did? They put their kitchen in their garage so they can turn that into space. I'm not saying you should do it, but I'm saying that's how they created that opportunity to have that write-off.
Yeah.
And they don't park their cars in it. They park their cars in the driveway.
Let me add this one thing. So another thing that you may be able to take advantage of by having a home office, in addition to having that bakery and stuff, have a separate home office, regularly exclusive for business, that you do management, bookkeeping, administrative activities out of, and you may open that up for opportunities for yourself. Just keep that in mind. All right.
Yeah. So I'm gonna piggyback on that real quick, guys. Are you guys still finding value? We got everybody still on the call, so you guys must be cool with the value that you're getting. This is the reason why we have a tax strategist, because we go talk to him before we make business moves. Like, we literally sit down and talk to him and think about these ideas before we do things, right? So that's the difference between an accountant who is who's reactive and a tax strategist who's proactive. Okay.
Yeah, great. Next question from Lucy. Hi, Lucy. Is, do you have to have an LLC? So I'm thinking that this question probably centers around, if you want to take advantage of these deductions and these write-offs and things of that nature, do I have to have an LLC for that to take place?
Great question. I love this question right here, because there's such a misconception or a myth. You do not have to have an LLC to write off business expenses, okay? So all the IRS says to be viewed as a business is you have to be involved in an activity and conducting that activity for the pursuit of profit. That is it. You're conducting that activity for the pursuit of profit. Now you open up, they're going to view you as a business. You can take all the write-offs, all the stuff that I talked about. Just keep in mind that LLC gives you legal protection. It is not even a tax entity, it's a legal entity, okay? So from a tax perspective, you get the same benefits as someone that has an LLC, all right? LLCs just provide you with legal protection, okay? Doesn't do much for you from a tax perspective unless you make elections.
Awesome. Thank you for that. Keisha, she's up next. The question she has is, can you convert to an S Corp if you've already been a single member LLC for years?
Yes, you can convert to an S Corp. So all you have to do is, talk with your tax professional. They'll kind of do an analysis first. That's the big part about going to an S Corp. You need to get that analysis done to see if the benefits outweigh the costs. Because if you're going to make an election to be an S Corp, it comes with additional costs. Your tax preparation fees are going to go up because now you have a business return in addition to your individual personal return. That's one. Plus, you have payroll service fees now. You got to put yourself on payroll. That's a cost that's associated with that. Also, in addition to that, you may have franchise tax, depending on which state you're in, which is the cost of just doing business, right? That's like $800 in some states that you'll have to pay. So you need to do a cost benefit analysis to see if it's worth it to be an S Corp, because once you go, it's not as easy to kind of revert back. All right, but you can make the election, file the 2553 form, and hopefully the IRS will approve you to be an S corporation. But you can do that.
Awesome. All right, Colette has a question. Her question is, the extra money that we have in our business checking account that isn't being used for business, should we move that money out or leave it in? I am an S corp. Are there any penalties?
So no, there aren't penalties for just having cash that's idle, okay? You've already been taxed on that money when you think about it. You've already been taxed on it. Just because it's in your bank account, you just didn't distribute it to yourself. So you already been taxed on that because you had your salaries and all of that good stuff. You just left it in your bank account. So in terms of if it's beneficial to kind of move it or things like that, it depends on your goals. So you can reinvest it in your business, right? If you want to continue to grow your business, depending on your goals, if you're trying to expand, or if you have other goals, let's say you want to invest in something, like talk about some of those property things that I was talking about. You want to get into a property, then that's a good idea to kind of move some of that cash to you personally so you can start investing in properties. So it really boils down to your goals, but you've already probably been taxed on that cash anyways.
Yeah, for sure. Yep. All right, Kevin, our good friend Kevin. Kevin, thanks for joining us. He's done some calls with us in the past talking about his strategies with investment properties.
I think Kevin was our first like Wealth Wednesday before it was Wealth Wednesday during COVID.
Before we coined it Wealth Wednesday, right?
Yeah. So quick story about Kevin. Kevin and I used to coach. I volunteered. He was a coach at Freedom High School. We quickly started talking more about real estate.
Been coaching.
That's
the record.
But it was dope, man. We've done multiple deals. He's bought a bunch of investment properties, bought a vacation rental property as well, but to see the people who started with you, who just saw you grow and to invest it and implement it, Kevin.
Yeah. And that's what we mean by do something with the information. Don't just sit on it, go do something. All right. So Kevin's question, let me go and ask his question. It was a follow-up question. And so if he has a property manager, does that negate the ability to carry over losses to W-2 income on long-term rentals? That's the first part of the question. The second part of the question is that on short-term rentals, I can carry over the losses though, because I'm actively involved in the management of that property. Just trying to get some clarity.
Got you. No, that's a great question. It sounds like he's kind of advanced with some steps. So from a long-term rental property, does it disqualify you? It depends on what you're trying to qualify for. So are you trying to qualify for it? Remember those exceptions that I talked about, active participation or real estate professional, okay? Because if you're trying to qualify for real estate professional status, we got a whole host of rules that we got to talk about, right? So if you're under the active participation and you're not involved in any management activities, it's going to be hard for you to get the active participation and then take that $25,000 loss against other income. Okay, if you're not involved in any of the management activity. Real estate professional status, they have specific rules around material participation. It's 7 steps, okay, of material participation. They implicitly state the different things you need to do in order to qualify under material participation. So it's based on those particular rules. So what I would suggest do is to look at those specific rules to see if you're doing those things in order to qualify under the real estate professional kind of exception to passive activity. I hope that helps out. Now on the short-term rental side, which is a little different, right? Short-term rental has a rule that states that if you rent out a property for less than 7 days or less on average, right? And you materially participate, but you also don't offer significant services, then you can use the losses from that property to offset against other income. So if you are meeting those at a high level, you may be okay in terms of using those losses to offset your other income, all right, on the short-term rental. Just look at those as 2 separate things though, right? Because on the surface, it may sound the same, long-term rental, short-term rental. The rules are totally different for both. Hopefully that helps.
Yeah, and one of the more reasons you got to pay for a tax.
Yeah.
Look, guys, we pay a pretty penny to Ronnie. Like part of what our payment was that, hey, I want you to share with some of our tribe, right? And he was graciously did that, but a high level of expertise comes at a cost, right? I'm gonna tell you guys, don't just call Ronnie and not pay and not expect not to pay. Like this was the free. This was the free, right?
Oh, it wasn't free.
No, this was the free to you. This is the free to you. But when you go talk to this guy, like this is the guy that, he's one of our top 5, right? And he ain't perfect. He ain't supposed to be perfect, but we work together and we figure things out and we're learning things together and I'll chime things off of them. And our business is complicated. We own over 50 properties and 7 different entities and 3-4 different partners. And it's all crazy, but we got somebody that we feel like we can work with. And that's the value of Ronnie.
And we save way more money than we spent. So
yeah, I was going to say that to Crystal. So if anybody that's looking for a tax advisor out there, because it may be different, right? You may be you may be elevating in your life. You may be blessed now, start to come into your income and things are going well. So now your problems change from looking for a refund or something like that to try to save money on taxes, right? So how to look at it in working with a tax professional and advisor is to look at the ROI. Okay, so for what I'm paying for this person, what am I saving? Compare that. Your ROI should be blown through the roof. Okay. If your ROI is significantly more than, when you're looking at what you're paying for, you're in good hands. That's how you need to look at working with kind of advisors.
Dope. All right. You want to give us your contact information, guys? Get your pens ready.
Yep. So let me give you my contact information. So if anybody wants to contact me, you can reach me at my website at rhythmaccounting.com. I'm also all over social media. I put out a lot of free content on social media. It's a little bit of edutainment. So in social media, you got to entertain a little bit and give some advice. Also, you can email me at rhythmaccounting.com. Okay. So those who want to get in contact with me, if you're looking for an advisor to take you beyond just preparing your tax returns, someone you can pick up the phone and call to make decisions. I'm having a baby, Ronnie, what we need to do from a tax perspective. I want to buy a property, what we need to do. I want to sell a property, what we need to do. I'm trying to start a business. I get all kinds of questions, okay? Because I need to know about your life because your life impacts your taxes, all right? So if you need somebody like that, here's my contact information. Feel free to reach out to me. I got one last thing I want to say to you guys. For the folks, this is just for Wealth Wednesdays, folks. I am offering a discount on 1-hour consultations with me, okay? All you have to do is send me an email at rhythmaccounting.com, add code WEALTHRA in the subject line or bottom or in the body of the email. What you'll get back from my virtual assistant, she'll send you out a link for a discounted consultation, 20% off just for folks that are on this live. All right? That's about it. I'm gonna kick it back over to you, Alan and Crystal.
Cool. You got the gift, guys. I hope you got a lot of value. Ronnie, I got a question for you. Can I borrow you for like 5 more minutes before you get your red wine?
Yeah, yeah, you can. You got me.
Before I get my red wine.
Yeah, you got me.
So I came up with this example, right? So
Yep.
I think a lot of people sometimes they don't understand what the true write-off, like the mortgage interest write-off for a property is. So I would love just to kind of go through this real quick. So what I did is someone who's making $150,000 yearly salary, they're taxed at a 24% tax rate. Let's say they bought a $600,000 home with a 10% down payment, which puts them at a $540 loan amount. All right. Mortgage payments are higher, guys, because interest rates are a little bit higher. So that interest rate, that payment's going to be around $4,000. And the yearly interest that they pay is around $30,000. All right. How does that calculate into what is this right? Do I just basically take 24% of 30,000 equals 7,000 is the yearly tax savings that they'll get from owning a home when it comes down to interest deduction from primary residence?
Yeah, so that's right from a marginal tax rate perspective. So we got the tax brackets, right? And if you look at your tax return, you don't really pay based on them. It's not really a marginal tax bracket. It's really effective tax rate when you really do the calculation. But yeah, in terms of estimating what your taxes are going to be, that is correct. For someone that's in the 24% tax bracket, they will likely get a tax savings of approximately $7,000. That's the true impact on their taxes. It's important to know that a tax deduction doesn't equate to the amount of your tax savings. All right. So when somebody say I get $100,000 tax deduction, that doesn't mean that they're going to get $100,000 in tax savings. Okay. That $100,000 will lower your taxable income, but it wouldn't translate to $100K in savings. Okay. So hopefully that's
can you break just that little small part down? Can you just give a quick example of like what you just said? I think that's like really gold.
Got you. So let's say you had a job, right? And you got a $100,000 job, right? That you made $100,000 from your job. That's your W-2 income.
So 100,000. I just wrote it down.
You made $100,000. That will put you into, I think, the 24% tax bracket, especially based on last year, 2022. Okay. 2002. Yep. So let's say of that 100K, you're likely going to pay $24,000 in taxes, right? Because that's the tax bracket that you're going to be in, right? Yep. So when thinking about deductions and things of that nature, off of $100,000, right? Let's say if you have a $10,000 deduction for whatever reason. Let's say, I don't know, you you had some you contributed to your 401k. Let's do it like that. All right. Contributed to your 401k $10,000. The effect of you contributing $10,000 will reduce your taxable income by 10K, but the effect will be multiplied by your tax bracket, that rate, that 24%. So a $10,000 tax deduction is really times 24% is what the total impact will actually be.
So what is that? Give me that number real quick. You got your phone?
So it's about a $2,400 tax savings.
Okay.
Yep. And that's based on the marginal tax rate. Put marginal right there because the 24% comes from marginal.
Okay.
Yep.
Got it.
Yep. So that's the actual impact of a $10,000 deduction. That's if you're in the 24% tax bracket. So anytime you say that again.
Finish what you're saying.
Yep. So anytime you hear someone saying you get this much of a deduction, just always think in your mind, okay, so what does that mean for me specifically? What's the impact for me specifically? Specifically for me, it's based off of my tax rate. Okay, specifically for me. So if I make $100,000, I'm in the 24% tax bracket. Someone say I can get a $10,000 deduction. I know to me that means a tax savings of $2,400.
Got it.
Okay, so always think about it like that because you'll see big numbers when people say you get these tax deductions. They're just lowering your tax liability, but that's not your actual taxes at the end of the day.
But what I look at it is I look at it as an asset is I'm purchasing it on a discount, right? Because if I'm investing $10,000 into something that is tax deductible and I get a $2,400 tax savings, right? Then I feel like that I'm buying it at a 24% discount the first year, right? So that's why I'm telling you guys that you got to start thinking more holistically when it comes to investing. And if you don't start thinking holistically, you're not going to get the full benefit.
Please just remember this last thing. If I can say this, I know we late. I'm sorry. Tax savings is wealth building, guys. Tax savings is wealth building. It's not just about doing a tax return, which is great and much needed. Tax savings is wealth building. It can either eat at your wealth or it can increase your wealth. Just keep that in mind.
That's love. Hold on, say that one more time. I need you to say that one more time. I need them to hear this. Say it one more time.
I said tax savings is wealth building. Okay, it is wealth building. People look at the two separately. It is wealth building. Taxes can either eat at your wealth or expedite and increase your wealth. Just remember that. Once you look at the tax code from that perspective, you'll be better off.
Yeah, awesome. Hey guys, in the chat, I think I put a couple of books that we would recommend that you take a look at. I don't get any money for promoting these books, so trust me, this is just books that I found a lot of value out of, things that we use. Of course, the first one, Tax-Free Wealth, kind of changed how I thought about taxes. To be completely honest with you guys, thinking about taxes is overwhelming. Let's just be honest, right? Only people like Ronnie love talking about taxes and thinking about taxes. The rest of us are like, I don't want to pay taxes. That's all we think about, right? But this book did change my perspective on how I thought about taxes and understanding how the tax code is structured for you to be able to take advantage of it in the proper way when you are an entrepreneur or business owner and you're doing the things the government wants you to do. That's number one. Next one is the psychology of money. So that's what this book looks like, just in case you go on Amazon afterwards and you want to go find it. It just gives you a perspective on how our psychology as it relates to money was created in these here Americas and how we need to unravel the negative implications of the way that we think about money. So that's a really good one. And then last but not least, The Win-Win Wealth Strategy. This is also another book by Tom Wheelwright. He also wrote this one. He also has a really great podcast that I really enjoy as well. So I would definitely look into some of his books that he has, and it kind of just gives you some no nonsense, straight approach ideas on how you think about your taxes and building your wealth. So those are some of our top 3 books recommendations when it comes to money, wealth, tax, and making sure that your tax plan is part of your wealth plan. Okay.
All right.
That's all we got for you. Thanks for hanging with us. I'm sorry we went long. It is 7:07. We did not stay honest to our 30 minutes, but I hope that you all got something out of it. We'll see you next month.
Yeah.
For our next
So
session.
here's the crazy thing. We already got 2 referrals, guys.
Thank
2
you guys.
referrals by text message. People have already referred clients to us. So that's dope. Thank you, AJ.
Thank you, Ronnie.
For sending us people. Ronnie,
Thank you.
we appreciate you. We value you. And thank you for spending time with us.
All right, guys.
Thank you.
Good night. Enjoy your dinner.
Right.